Has a lender ever recommended to you to get a combo loan? Hi, this is Trevor Calton from Evergreen Capital, and today we're talking about combo loans. In this video, I'll explain what a combo loan is, how it's used, and how it benefits the borrower. A combo loan is actually two separate loans. It's frequently used when a borrower wants to get 80% or higher loan to value. The primary purpose of a combo loan is to lower the overall payment for the borrower and potentially lower their interest rate. Let me show you the basics of a combo loan, how it's structured, and how it works. Imagine a borrower is looking to purchase a $1 million property, and they're trying to borrow $800,000. That would be an 80% loan to value. A lender might offer 80% loan to value, or the $800,000 loan, at an interest rate of, say, 6%. One thing to know about loans that are 80% loan to value or higher is about the concept of private mortgage insurance, or PMI. If a borrower is taking 80% or more leverage on a property, they're not only going to pay 6% on the interest rate, they're also going to pay up to 2 to 3% more for private mortgage insurance so that the lender can reduce their risk of the borrower defaulting. A combo loan gives the borrower a way around having to pay private mortgage insurance and potentially also gives them a lower overall cost of funds. Let's look at an example. A lender might offer the borrower, say, $600,000 as a first mortgage and then another $200,000 as a second mortgage. And this first mortgage might be at, say, 5%. The second mortgage might be at 10%. At first glance, one might think that this is much more expensive. But the concept of incremental borrowing cost shows us that when you look at the total payment of the $800,000 loan at 6% plus the private mortgage insurance would actually be greater than the combined payment of the $600,000 loan at 5% plus the $200,000 loan at 10%. I'll cover incremental borrowing cost in another video, but just know that the primary purpose of a combo loan is to save the borrower the cost of private mortgage insurance and potentially lower their overall cost of funds that they're paying to borrow the money. In order to determine which is the best option, here are the steps that you need to take. The first thing you do is determine what the payment would be, including the private mortgage insurance, on the singular loan. Take that total and then compare it to what would the combined payments be for the first and the second mortgage. If you find that the payment for the combo loan is the same or lower than the payment on the main loan plus the mortgage insurance, you would absolutely want to take the combo loan. For more in-depth training on this type of analysis, check out my online courses. In my full online courses, I teach all of the analysis related to combo loans, incremental borrowing costs, and mortgage analysis. This is Trevor. Thanks for watching.